In the last couple months, two very important things have happened. America's debt has done something it hasn't done since World War II, crossing over 100% of GDP. And the second thing you may have already heard about. It's not exactly a secret now that the war in Iran has thrown the global markets into a bit of a turmoil. Oil, which once lived at around $50 to $60 a barrel, has now exploded past $100 for the best part of 2 months. And even if the war were to end tomorrow, enough infrastructure has already been destroyed that oil prices could remain high for many more months, even years. But it seems like nobody is talking about how these two things act together. How this tidal wave is about to hit America's biggest pressing issue. It's ballooning national debt. The US is currently $39 trillion in debt, and nearly a third of that, $10 trillion, matures this year and will have to be refinanced. However, the America today is very different from the America which existed when this debt was originally issued, and people are starting to get spooked. China, Japan, even America's own companies have all been selling their US debt, and bond yields have climbed to their highest rate since just before the 2008 financial crisis. It's no secret that America has a debt problem, but could this finally be the moment when it all goes bad? Here's what happens when the oil crisis hits America's debt. Okay, so it's now been over 3 months since the start of the Iran war, but we're only really now starting to see the impacts pop up in our day-to-day lives. Gas prices in the US have peaked to over $4 a gallon, and inflation, which was trailing at around 2%, is now expected to rise above 4%. But perhaps most importantly, America's bond yields, how much people need to be compensated to lend them money, has shot up, and it's now at the highest price in 20 years. This isn't really being that widely reported in the news, but it's probably the biggest consequence of the war right now. At the moment, it's spiked by about half a percentage point, which doesn't really sound like a lot, but when you apply that across America's ever-increasing national debt, it works out to roughly another $180 billion every year. And this is really America's biggest vulnerability. Not oil or AI, or even China, but decades of deficit spending that has left them totally reliant on other countries and institutions plugging the gaps in their spending. But as bad as this is, people have known about America's debt for quite a while now. Like, as far back as the early 2000s, people were ringing the alarm bell on America's ballooning debt.
Monstrous federal deficit. It's getting worse year by year.
This has been the most fiscally irresponsible administration.
And yet, in that period, countries still lent them trillions of dollars. So why is it only now that it's starting to hit the fan? This is how much America spends in a year. It's everything from public schools to Medicaid. And this is how much America earns in a year. Pretty much their total tax revenue. And when you put these two side by side, you pretty quickly notice a problem. America spends about $1 trillion more than it brings in, and has done this for nearly every year in the last couple of decades. This is obviously a problem, and to plug that gap, it borrows the money. They do this by issuing treasury bonds, basically IOUs, a simple promise that in 10, 20, 30 years' time, America will repay them the total amount, plus interest. Now, because of quite a few different reasons, these treasury bonds were for a long time considered to be the safest asset in the world. America was the largest economy, and the most stable economy, and therefore the best and safest person to lend to. Because of this, over the years, a ton of people have lent America money. Pension funds, big investors, even foreign countries all have a slice of the pie. And over time, it's created this. America's total debt, $39 trillion of it. It's a number so big that it's nearly impossible to comprehend, but it's still money owed to someone. Now, this is a bit of a simplified version of a more complicated system, but at its core, it just about works. Sure, these yield curves may go up and down a bit, but they still roughly stay at the same level. However, things start to get a little tricky when people want their money back, and they start to get very tricky when lots of people want their money back. Let's imagine that you're running the National Bank of China. From day one of the Iran war, it was fairly obvious that there was going to be a major oil shortage. So to try and get ahead of the curve, you decide you're going to stock up on millions of barrels in advance. Enough to fuel your factories for at least a few months while you figure out new shipping routes. But in order to do that, you first need to get your hand on a ton of dollars, as that's pretty much the only currency in which oil is sold internationally with. How do you get those? Simple. You sell some of your US Treasury bonds you've been buying up over the last couple of decades back to the US investors. Now, imagine it's not just China doing this, but Germany, the UK, Japan, France, pretty much every major international holder of US debt all selling at once. In the 2 months since the war began, foreign central bank holdings of US debt fell by over $100 billion, the steepest drop since the pandemic. Unsurprisingly, this has thrown the US debt market into something of a tailspin. It's a bit of an oversimplification, but the basic issue is that even if a ton of people are selling US debt, the US is still spending way more than it earns, and it still needs to borrow money to fund its day-to-day operations. So to get people to lend money when most countries have no interest in lending to the US, they need to offer higher interest rates to attract that cash back into US government coffers, which is why that rate has been spiking ever since the start of the war. That might help fill the gap in the budget for now, but it means that down the road, the US government will be stuck paying even higher rates than it already does on the $39 trillion something in debt that it already owes to the rest of the world. Every time a country, let's say Japan, lends the US money, they receive a treasury bond, a piece of paper saying, hand over $1,000 today, and you'll get 5% of that every year for a decade, plus your $1,000 back at the end. But imagine a couple of years in, the US starts looking a little riskier than it did when Japan first signed up. So Japan decides to sell the bonds. Of course, everyone else in the market can see the same risks. So instead of paying $1,000, the buyer instead says that they'll only buy the bond at a discounted rate of $800. It's a pretty good deal for the buyer. They're going to get the original bond's $50 annual payments, along with a promise for the $1,000 when the bond expires. However, the problem for the US is that nobody is going to want to buy new bonds with the original terms when they can just get a better deal by buying Japanese discounted ones. So to attract new lenders, the US has to offer higher interest rates. Now, the idea that countries would sell US debt because they don't believe the US will actually pay it back might seem a bit far-fetched. In practice, when US debt comes due, the government simply issues new bonds to cover the old ones, rolling the debt forward indefinitely. They've been doing this for decades, and the consequences of actually stopping would be so catastrophic for the global financial system that almost nobody seriously expects it to happen. So if nobody thinks the US is going to default, why are people still selling? Well, because defaulting isn't the only reason to dump a bond. And there are a few key reasons why the Iran war is making US debt even less attractive, even if everyone still expects to be paid back. The first is that it's almost certainly going to create a lot of inflation. Oil sits underneath the cost of almost everything else in the economy. And if there's a shortage, then shipping gets more expensive. So anything which is imported costs more. Fertilizer is derived from fossil fuels, so food prices rise. Manufacturing requires huge amounts of energy, so anything which is built in a factory becomes more expensive. Now, we're recording this in the middle of May, and the Strait of Hormuz has been shut for about 3 months now, which means about 20% of the world's petroleum supply has just stopped. Inflation hasn't hit yet because an organisation called the IEA, the International Energy Agency, coordinated the largest release of oil reserves in history, about 400 billion barrels. But that's only expected to cover part of the gap for a few weeks at most. So even if inflation hasn't hit the US yet, it almost certainly will in the next month or so. If you're a foreign government with billions of dollars loaned to the US, you won't be particularly thrilled about that prospect. Say you lent the US $1,000 for 5 years, and over the course of that loan, inflation runs at 5% a year. By the time you get your money back, it buys roughly $250 less than what it did when you handed it over. So to avoid that, countries just sell their debt before inflation takes place. Add to this the fact that people need to sell bonds in order to get the dollars they need to buy oil. And it's hardly surprising that demand for these assets has plummeted. Since the start of the war, 7 of the top 10 holders of US debt have cut their holdings. And as we know, the more people that are selling debt, the higher the interest rate the US needs to pay to attract lenders. At this point, every loan the US government secured will have to pay around 0.5% higher interest than they did before the war, and spread that across the entire national debt, and that alone will cost the government $180 billion every year, which would be enough to build around 1,800 miles of high-speed rail, or fund the entire NASA budget 4 times over. In normal circumstances, the damage would at least be contained. Higher rates only applied to new loans, while the old loans stayed locked in at whatever rate they were originally issued at. But today the US is going through a period of what's known as debt refinancing, meaning a huge chunk of its loans it took out years ago are now coming due and need to be repaid. In total, around $9 trillion worth of debt is maturing this year alone. Of course, the US isn't actually going to pay that money back. Instead, they'll take out a fresh set of loans and use that money to pay for the old ones. The problem is that a lot of that $9 trillion was borrowed a decade ago, when interest rates were much lower. And given how much interest rates have gone up since then, rolling this debt over means locking in a significantly higher rate on an enormous pile of borrowing for at least a decade. Okay, so it's safe to say that government finances are in a pretty shaky situation right now. But with all of this in mind, it's important to remember that the majority of holders aren't actually foreign governments, who make up just 30% of the total. The rest actually comes from American firms themselves, US investors, departments of US government, and the Federal Reserve. You might expect that this would act as something of a buffer against the selling pressure. After all, a pension fund in New York can't escape American inflation by selling US bonds. The problem is, because of the specific way that a lot of Wall Street actually holds their debt, rather than acting as a buffer, it might actually do the opposite. Right now, roughly $2 trillion worth of US government debt is being held by hedge funds, running what's known as an arbitrage trade. Imagine you notice that a £50 Amazon voucher is being sold for £49.80. Since the voucher is ultimately worth 50 quid, you'd expect its price to eventually converge back to that level. So, if you wanted to make some small but reliable money, you could buy the voucher and wait for that to happen and then pocket the 20p difference. And that's exactly what these hedge funds have been doing with US Treasury bonds, just on a much larger scale of trillions of dollars at a time. Because the gaps in the price are so small, the only way to really make the trade worthwhile is by borrowing huge amounts of money and then using that to make the same trade thousands of times simultaneously. Like anybody else, to borrow that money, funds have to put down a deposit, a bit like a down payment on a mortgage. And in normal times, that's fine, because the returns on the trade are about as close to risk-free as anything in finance gets. But if the market suddenly becomes a lot more volatile, because say a wave of foreign governments all start dumping bonds at the same time, then the people lending out the money tend to demand a bigger deposit, just to cover their backs in case something goes wrong. And the fastest way for a hedge fund to raise that cash is just to sell some of the treasury bonds that they're already holding, which of course pushes the interest rate in the market up all over again. Because trillions of dollars are being held in these trades at any given moment, even a relatively small move in international markets gets amplified several times over, massively pushing up the government's cost of borrowing in the process. With all of this, it's important to remember that it's not just the government who's at risk here. The 30-year mortgage rate, for instance, has historically tracked at roughly 2% above the 10-year Treasury yield. The logic being that if you can earn 4.5% lending to the US government risk-free, you're going to demand that plus something extra for the additional risk of lending to a home buyer or a company. So when Treasury yields rise, that increase flows through into mortgages, business loans, credit cards, and the cost of borrowing across the entire economy moves with it. In normal times, this is exactly the situation that the Federal Reserve exists to manage. But you may have noticed that there's been some controversy around the Fed recently, specifically around the new chair, Kevin Warsh, who replaced Jerome Powell earlier this year. Now, without getting too deep into the politics of it all, the new chair conveniently shares Trump's view that an AI-driven productivity boom is just on the horizon, and that because of this, the Fed should actually now be cutting rates and letting businesses borrow more money and invest more. The problem is that cutting interest rates would also mean more money flowing around the economy, which is one of the classic drivers of inflation. In a stable environment, that's a gamble you might reasonably take. But with the Iran war already threatening to push up prices, this would create a massive risk of inflation. And the thing is, even though the inflation caused by the oil shock will of course eventually pass, the cost in terms of government debt wouldn't reset so cleanly. The $9 trillion being refinanced right now will carry higher interest rates for the next decade. That obviously doesn't mean America is about to collapse, but there is a real possibility that over the next 12 months, the interest bill quietly becomes the largest single line item on the federal budget, and stays that way for decades to come. And if that does end up happening, it will place a massive constraint on what America can actually afford to do. The Iran war didn't create America's debt problem, but it may be the thing that finally makes it impossible to ignore.